Did you know that the total global cryptocurrency market has, at its peak, exceeded the combined GDP of every nation in sub-Saharan Africa? Right now, on Thursday the 2nd of July, 2026, the crypto market is sitting at a genuine inflection point, and today's analysis could be one of the most consequential you watch this year. Welcome back. Whether you are a seasoned trader, a long-term investor, or simply someone trying to make sense of where digital assets are heading, today we are breaking down everything that matters. We are examining Bitcoin's current price dynamics and on-chain behavior, the state of the broader altcoin market, fresh regulatory developments from both the UK Financial Conduct Authority and the EU's MiCA framework, and what the latest institutional research is telling us about where confidence actually sits. There is a great deal of noise in this market every single day. Our job is to cut through it and deliver signal. So let us get straight into it. Bitcoin remains the benchmark by which every other digital asset is measured, and today is no different. As the world's largest cryptocurrency by market capitalization, Bitcoin's price action sets the tone for the entire market. Analysts are currently monitoring key support and resistance levels that have formed over recent weeks, with on-chain data pointing to notable shifts in wallet distribution, specifically, the balance between long-term holders and short-term speculators. One of the most reliable metrics right now is the market value to realized value ratio, commonly known as the MVRV score. This indicator compares Bitcoin's current market price against the average price at which all circulating coins last moved on-chain, giving us a cleaner picture of unrealized profit and loss across the entire network. When the MVRV score rises sharply above a value of 3, historical data consistently shows elevated risk of a market-wide correction. Equally important today are exchange inflows and outflows. When large volumes of Bitcoin migrate from cold storage wallets to exchange hot wallets, it often signals increased selling intent. Right now, that metric deserves close attention. Beyond Bitcoin, the altcoin market tells its own story today. Ethereum, the second largest digital asset by market capitalization, continues to be defined by the performance of its Layer 2 ecosystem. Networks such as Arbitrum and Optimism have consistently attracted developer activity and meaningful total value locked, demonstrating that Ethereum's scaling roadmap has delivered practical results rather than merely theoretical ones. Solana, meanwhile, has maintained its competitive position in terms of raw transaction throughput, routinely processing tens of thousands of transactions per second at a fraction of a penny in fees, a capability that continues to draw both retail users and decentralized application developers. In the DeFi sector, total value locked across all protocols remains a key barometer of genuine market confidence. Research from leading blockchain analytics firms consistently finds that TVL movements tend to lead price action. Liquidity entering DeFi protocols frequently precedes broader market appreciation. Today, sector rotation between large-cap and mid-cap assets is particularly worth watching, especially within the artificial intelligence and real-world asset tokenization verticals, both of which have drawn serious institutional capital throughout this year. Regulation is arguably the most powerful external force acting on the cryptocurrency market right now, and two frameworks dominate the conversation. In the United Kingdom, the Financial Conduct Authority has continued to build out its crypto asset registration and supervision regime, placing consumer protection and market integrity at the center of its approach. Firms operating without FCA registration face meaningful enforcement risk, which has had the effect of concentrating legitimate activity among properly registered providers. Across the channel, the European Union's markets in crypto assets regulation, known universally as MiCA, has now fully embedded itself into the European financial landscape, creating a comprehensive licensing regime for crypto asset service providers operating across all 27 member states. For UK-based exchanges and investors, MiCA creates both a compliance challenge and a commercial opportunity. Access to the EU market requires navigating MiCA requirements, whilst the UK's own separate regulatory path offers a degree of flexibility that some firms find strategically attractive. Research published by the Cambridge Center for Alternative Finance consistently demonstrates that regulatory clarity, rather than regulatory restriction, is what drives market maturation and long-term institutional inflows. Today, clarity is steadily increasing. Institutional participation has fundamentally and permanently changed the character of the cryptocurrency market. Since the approval of Bitcoin spot exchange-traded funds in the United States in January 2024, we have witnessed a sustained reshaping of who holds Bitcoin and with what intent. Asset managers, sovereign wealth funds, family offices, and even certain pension fund allocations have integrated digital assets into their portfolios, treating Bitcoin in particular as a macro hedge alongside gold and inflation-linked government bonds. Today, the institutional lens on crypto extends far beyond price speculation. Major firms are conducting deep research into the tokenization of real-world assets, including government bonds, commercial real estate, and commodities, with the Bank for International Settlements estimating the tokenized asset market could reach trillions of dollars in notional value within this decade. Asset managers including BlackRock and Fidelity have expanded their digital asset divisions considerably. This institutional depth provides a structural demand floor beneath major assets, reducing, though never eliminating, the extreme volatility that characterized earlier market cycles. Today, the smart money watches on-chain flows, stablecoin issuance, and futures open interest as its primary market intelligence tools. Good market analysis is only as credible as the data underpinning it, and today's crypto research ecosystem is richer and more rigorous than at any prior point in the asset class's history. On-chain analytics platforms such as Glassnode, Chainalysis, and Nansen provide real-time visibility into blockchain activity that simply did not exist a decade ago. Several metrics are worth tracking closely right now. First, the number of active addresses, wallets that have sent or received a transaction in the past 30 days, serves as a proxy for genuine network adoption rather than speculative price activity. Second, stablecoin transaction volumes are an exceptionally useful signal. Research consistently shows that periods of rising stablecoin inflows to exchanges tend to precede bullish price action, as this represents uninvested capital, dry powder, ready to be deployed into digital assets. Third, for Bitcoin specifically, miner revenue and hash rate trends signal network health and miner profitability, both of which carry second-order effects on market-wide selling pressure. When miners are profitable at current prices, they tend to hold rather than sell, reducing circulating supply. Today, all three of these signals are worth examining in parallel. So where does the weight of today's analysis actually point in the near term? Several factors are worth holding in mind. First, central bank policy in both the United Kingdom and the United States continues to exert significant influence over all risk assets. Periods of stable or declining interest rates have historically been constructive for cryptocurrency markets, as lower yields reduce the opportunity cost of holding non-yielding assets. Second, the broader narrative around digital assets in 2026 is increasingly one of infrastructure maturation rather than speculation. The underlying technology is building out, institutional frameworks are solidifying, and retail adoption, particularly across emerging markets in Africa and Southeast Asia, continues to expand meaningfully. Third, historical patterns following Bitcoin's halving events, which reduce the rate of new supply issuance by 50%, have typically shown their most pronounced market effects in the 12 to 18 months following the halving. Analysts with genuine credibility in this space consistently advise against short-term price prediction in favor of understanding the structural tailwinds, digital scarcity, programmability, global accessibility, and the long-term shift of the financial system toward digital infrastructure. Today's cryptocurrency market is genuinely complex, fast-moving, and consequential, not merely for traders and investors, but for the architecture of the global financial system itself. Let us close with the clearest possible takeaways from everything we have covered. Bitcoin's on-chain fundamentals, MVRV, exchange flows, and holder distribution remain the most reliable long-term guides even when short-term price action is noisy and confusing. Regulation, specifically MiCA in Europe and the FCA's evolving framework in the UK, is a clarifying force for this market, not a destructive one. Legitimate operators benefit from it. Institutional research is deepening the market's credibility and providing structural demand. And altcoin opportunities are real, but they demand proper due diligence rather than momentum chasing based on social media sentiment. Whatever position you hold in this market today, stay data-driven, maintain a healthy skepticism toward hype, and always size your risk appropriately to your own financial circumstances. If today's analysis was useful, make sure you are subscribed. We publish daily breakdowns right here. Until tomorrow, stay informed and invest responsibly.